Mark, Capital Intelligence, Greater Central Asia. My question is to Secretary Summers. As the Chinese say, we live in interesting times. How do you explain this unnatural, it seems to be unnatural volatility and lack of volatility in our financial markets? We have all this stuff going on, but our markets don't seem to be moving anywhere. You know, and especially you see this in Chicago on the Merc, you see this on equity market. The only volatility seems to be on the Bitcoin exchanges. Can you explain why we're not seeing this, and how much should we worry about it?
I think in general, it's a lesson. This isn't new. It's a lesson of history that huge geopolitics is less associated with market moves than you think. If I showed you a graph of the U.S. stock market daily, and I didn't label the dates, and I accepted a very broad way, and I said, tell me when the Cuban Missile Crisis was, tell me when 9/11 was, tell me when Kennedy was shot, tell me when VJ Day happened, you'd have a hard time doing it. And so as a general matter, it's just a long-term historical observation that stuff that seems really pretty exciting to State Roy doesn't seem very exciting to markets. And there's bunches of stuff markets get excited about that doesn't seem that exciting to State Roy. The two worlds are in general more disconnected and have been for a long time than one would expect. That's the first thing I'd say. Second, there's a systematic tendency when markets go up for them to become less volatile. And for some set of reasons, they've gone substantially up, and that would be associated with them being less volatile. Third, it has been, in the micro, a relatively placid period. That is, if you look at corporate earnings announcements and you look at how often and by how much corporate profit announcements have surprised, the surprises this year have been unusually small. If you look at the dispersion of forecasts, take the 95th percentile forecast of GDP growth for next year and the 5th percentile forecast of growth for next year, they are unusually tightly compressed. So I think those are all elements that go into the explanation for why this is. There's also a view that I would put a little less emphasis on, but that people who are sophisticated in markets would put a lot of emphasis on, that policy authorities are more committed to having stability than they used to be. And so if you have a Fed who's much more likely to cut interest rates if the stock market falls, or to not raise interest rates if the stock market falls, and will raise them much faster if the stock market starts to go up, that operates, come what may, to be stabilizing of the stock market. So I think those would all be elements in the story in answer to your question.
Thank you.